Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Let's start with a few important facts. Central banks do not print growth. Governments do not boost productivity. However, both perpetuate inflation and have an incentive to increase debt. Adding these facts to your investment thinking may not guarantee high returns, but most importantly, it is likely to prevent enormous losses. As many longer-term subscribers to Matasi.com are well aware, we follow Warren Buffett's sage 3 rules of investing. Number 1, don't lose money. Number 2, don't lose money. 3, never forget rule 1 nor number 2. We believe we have now entered an era of extremely difficult investing. We at Matasi.com refer to this period as the beta drought decade, which we believe was originally coined by the Australian Gerald Minack, who founded Minack Advisors. I thought it timely to lay out why we came to feel this way. As such, we will discuss the subjects outlined here. Stagflation. That is the risk ahead. A Fed pivot would do nothing to bring markets higher in that scenario. Stagflation periods have proven to be extremely poor for stocks and bonds. They are even worse when governments are unwilling to cut deficit spending because of the crowding out of the private sector works against a rapid recovery. We're highly confident of seeing this stagflationary period ahead, which we have previously written and produced videos about this coming problem. We've increasingly become convinced this stagflationary period will be historic and might be labeled in the future as actually the stagflationary debt crisis era. Time will tell. Let's just focus this session on what we are confident of, and that is an era of stagflation. The debt crisis element has a lot of yet to be answered questions about how the powers to be will once again cheat or change accounting and regulatory rules or employ any number of games to simply kick the can down the road, a road we have been on since the dot-com bubble imploded in 2000. U.S. investors have enjoyed historic beta for a dozen years. A 60-40 equity bond portfolio generated a 10.5% annual average return between March 2009 and January 2022. There's been 4 beta droughts since 1900, extended periods of little or no beta return. 3 of the 4 historical beta droughts in the 1910s, 1940s, and 1970s were caused by rising inflation, typically decade average CPI inflation of over 5%. Those 3 inflation episodes were associated with World War I, World War II, and the 1970s oil shock. The U.S. may now be entered into another beta drought. U.S. returns are now at risk from both the prospects of higher inflation and the headwinds to returns from high starting point valuations. Larry Fink, the founder, chairman, CEO of BlackRock, recently emphasized the following numbers. Just a year ago, the U.S. 2-year Treasury notes were yielding 25 basis points. Today, they're earning 4%, with corporate bonds over 5% and high yield above 9%. If we go back to 1995, before Congress repealed the Glass-Steagall Act, which was brought into being as a result of the 1929 stock market crash in 1933, you could get a 7.5% yield with a portfolio of simply 100% riskless bonds. If you fast forward 10 years into 2005, it had to be 40% equities, 50% bonds, and 10% alternatives. Then move another 10 years, and in 2016, you needed 60% equities, 15% bonds, and 25% alternatives. This describes the growth of several markets, with investors having to take on significantly more risk for even a shot at the same return. Today, to get that same 7.5% yield, a portfolio could be 85% bonds and 15% equities and alternatives. We're not far from returning to potentially the 1995 benchmark levels. What this suggests is that the increasing risk that investors have accepted over the last decade will likely be purged over the next decade, or at least significantly lowered. S&P 500 real prices and cyclically adjusted PE ratios are more than likely to regress to more normalized levels represented by the dotted exponential plots here. The famous George Soros' lieutenant, Stanley Druckenmiller, believes that could be the case, and I quote him, "There's a high probability in my mind that the market, at best, is going to be a kind of flat 10 years, sort of like the 66 to 1982 time period." End of quote. Druckenmiller added that with inflation raging, central banks raising rates, deglobalization taking hold, and the war in Ukraine dragging on, he believes the odds of a global recession are now at the highest in decades. He points out that globalization has deflationary effects because it increases worker productivity and speeds up technological advancement. However, the tailwind is now fading. To quote Druckenmiller again, quote, "When I look back at the bull market that we've had in financial assets, it really started in 1982. All the factors that created that boom not only have stopped, they've reversed." End of quote. All of the excess of unproductive debt issued during a period of complacency will exacerbate the problem in 2023 and 2024. Even if refinancing occurs smoothly, but at higher costs, the impact on new credit and innovation will be enormous, and the crowding out effect of government debt absorbing the majority of liquidity and the zombification of the already indebted will result in weaker growth and decreased productivity in the future. Lance Roberts at Real Investment Advice has some great analysis that shows valuations by their very nature are horrible predictors of 12-month returns. However, in the longer term, valuations are strong predictors of expected returns, as can be seen here of real total rolling 10-year returns. Overpaying for value can be expected to lead to lost decades. Another chart Lance uses shows this more closely by highlighting the three most recent points for reference: the dot-com bubble peak, January 2009, the start of the current bull market, and the ending valuations for 2021. There are two crucial points to take away from his data. There are several periods throughout history where market returns were not only low but negative, given that most people only have 20 to 30 functional years to save for retirement. A 20-year low return period can be devastating to those plans. Periods of low returns follow periods of excess market valuations and encompass the most negative return years. The problem going forward, as Druckenmiller also notes, is the reversal of globalization and financial inputs that increased annual return rates over the last decade. While the Wall Street Journal tries to make the case that profit margins were responsible for the gains, the reality is that most excess returns came from just two unique sources: a decade of monetary interventions and zero interest rate policies, and a massive spending spree by corporations on share repurchases. The chart by Pavilion Global Markets shows the impact of stock buybacks on the market over the last decade. The decomposition of returns for the S&P 500 breaks down as follows: 21% from multiple expansions, 31.4% from earnings, 7.1% from dividends, and 40.5% from share buybacks. Since 2001, the S&P 500 alone has employed approximately $10 trillion of corporate capital to buy back its shares, with no other real purpose than to drive up stock prices that have now started to come down, as nearly $29 trillion in wealth has been extracted from the equity and bond markets since the beginning of the year. I put the bond market losses in that number because a substantial amount of money used for buying back corporate shares was borrowed. The primary way of doing this was issuing new corporate bonds. Effectively, they swap future debt obligations for equity prices today. Those who sold their corporate equities today have had the opportunities to exit before the debt has to be paid. They have fled the party as market prices became unsustainable, since knowingly debt payments would eventually depress earnings. Corporations also use borrowed money to pay dividends. These dividends paid more than treasuries and bank rates, thereby making stocks attractive to yield-starved investors and institutions. This, coupled with stock buybacks, was a giddy cocktail for the markets. According to a just-released Fed paper entitled "The Coming Long-Run Slowdown in Corporate Profit Growth and Stock Returns," and I quote from the report, The reduction in interest and tax expenses is responsible for a full 1/3 of all profit growth over the prior 2-decade period. That boost in corporate profits is unlikely to continue, indicating notably lower stock returns in the future. When profits and growth fall, normally cash flow falls off. This means a high probability fall off in the $10 trillion rate of stock buybacks, reduced cash and borrowing capabilities for inflating dividend payouts. Instead of reduced interest expense, we are now seeing rising interest expenses on the income statement. Instead of reduced tax expenses, we're now seeing rising tax expense, with U.S. government's new 15% minimum corporate tax being implemented of the recently signed Inflation Reduction Act. We can therefore expect the beta drought to be a very real eventuality. As demand weakens domestically and globally, investors should not expect corporate profits to remain near record levels. As shown, the current gap between asset prices and corporate profits is at the greatest deviation on record. According to Jeremy Grantham, and I quote him here, profit margins are probably the most mean reverting series in finance, and if profit margins do not mean revert, then something has gone badly wrong with capitalism. If high profits do not attract competition, there is something wrong with the system, and it is not functioning properly. According to the well-followed and respected analyst Dr. John Hussman, and I quote also, surveying the current condition of the financial markets, we presently observe a combination of still historically extreme valuations, rising yet still only normalizing interest rates, measurably inadequate risk premiums in both equities and bonds, and ragged, unfavorable market internals suggesting continued risk aversion among investors. In this context, it's worth repeating what I've noted across decades of market cycles. A market collapse is nothing but risk aversion, meeting an inadequate risk premium, rising yield pressure, meeting an inadequate yield, end of quote. Hussman's chart shown here lays out his best estimates of the expected 12-year total return for a conventional passive investment portfolio, investing 60% in the S&P 500, 30% in Treasury bonds, and 10% in Treasury bills. Notice that the recent market losses have markedly improved prospective return for a passive investment allocation, yet only to a level of about 1% annually. Indeed, the expressed returns of the S&P 500 components is still negative. I encourage you to review some of the detailed analysis on total expected returns over the next decade that Hussman's analytically strongly indicate. I list here his last 3 reports. According to research by Deutsche Bank, history shows that once inflation rises above 5% in developed economy, it takes at least a decade to bring it down to 2%. Even the OECD expects persistent inflation in 2023 against a backdrop of weakening growth. I've written extensively about the reality that we have both inflation and deflation concurrently. They exist concurrently in different areas of the economy and shift. What shifts in a much larger manner, however, is public perception, media narrative, and market focus. In 2020, as COVID-19 hit, I put out a video entitled Inflation Plus Deflation, specifically reinforcing this point. It can be found at matasi.com. Inflation can only be expected to trend higher as we inevitably head towards a final hyperinflationary blow-off of fiat currencies. Meanwhile, we can expect deflationary pressures to increase. It is highly likely the next major deflationary pressure will soon come from recessionary pressures. We are likely very near the pivot point now. However, don't be misled. Inflation will be with us for the next decade. It may and is likely to fall based on official numbers to maybe as say 5%, but it will be there nevertheless. We will be in an era of continuous policy initiatives to rein in inflation to manageable levels. However, with the size of global debt, the opportunity to inflate away some of that debt is not going to be missed. We are now only in the first phase of what is likely to be a 3-phase process before we see inflation being possibly contained. We are now in the midst of an energy refining and extraction crisis that will last minimally through 2023, if not longer. In 2023, energy is likely to be the only thing that matters to investors. Everything else, including the Fed, will be a sideshow. Who's ready for the insanity wave? We just had a half-year pause in my oil thesis. Now it's potentially about to resume with vigor. Soon we'll see a global food crisis, which is already being felt in many emerging countries. It is likely to be a prime inflationary fire in 2023 through 2024. In the 1920s, we could find ourselves in a radically different situation to the 2010s. Inflation will always be a little too high as opposed to too low, and with both monetary and fiscal policies pivoting a full 180 degrees, we will again have a tug-of-war, but a battle that pushes firmly in the direction of higher interest rates rather than a disinflation and the NERP of the post-Great Financial Crisis era. Inflation and deflationary pressures will come at us from major shifts in the world order. What I'm talking about by world order is the change in trend in the items outlined here. My colleague Charles Hugh Smith and I have done 3 45-minute videos this year on exactly the importance of these shifts. All can be found again on the Matasi.com website. We fully expect a major crisis within the $2.2 quadrillion derivatives complex to ignite yet another government printing episode of even more egregious new government policies. The broken credit transmission mechanism is now fractured for many reasons, but most of all because of a shortage of unencumbered collateral. We have reached the point where credit growth can no longer sustain an over-indebted and over-leveraged system. The U.S. and most developed economies' debt is quickly becoming unfundable without dramatic actions being taken. If this is not enough, U.S. productivity is now in freefall because of a decade of malinvestment and underinvestment into productive assets. It will take the next decade, or possibly more, to clear the monetary malpractice, fiscal excess, and global imbalances from the system. It will be a beta drought decade. The coming decade will likely be referred to as the Great Stagflation, similar to the 1930s being called the Great Depression. There is all likelihood it may be worse and eventually be labeled the Great Stagflationary Debt Crisis. Throughout the last decade, China has come to the rescue of the global economy on 4 separate instances to keep this boat afloat. This isn't going to happen again. In fact, China may soon become a serious economic problem to the world, similar to what occurred in Japan in the 1990s, like Japan imploding from being an export-led dependent economy. China, as even a larger export-led economy, but additionally dependent on capital formation, may soon experience major problems associated with deglobalization, definancialization, reshoring, degrowth, and global economic rebalancing. The black hole of inflation is very real, especially to the U.S. That is because we have been fooling ourselves with bad economic, inflationary, and growth information. Like a black hole, stagflation is similar, and that the only real solution is to avoid its deadly grasp. You must stay above the event horizon at all costs. Unfortunately, because of false and manipulated data on inflation and economic growth, the U.S. is already below that event horizon before we can even begin to fight stagflation. I've outlined this in prior videos, also available on our site. What can we conclude? The evidence is pretty overwhelming that the next decade is going to be challenging. There is a lot of data that suggests the dam is broken. However, never underestimate the games the powers to be will stoop to keep the game going. They can be expected to change the rules to kick the can down the road. We fully expect that. And as this chart shows, we don't think the markets have yet stopped rising. We're likely to see a new high or a double top before the game finally implodes. That lift will again be built on a false foundation of bad data, flawed accounting, and regulatory gaming. That market lift shown here will be short-lived and eventually will only be seen to be a major counter rally in a potentially historic bear market. A bear market in financial assets that will coincide with a stark resetting of the standard of living in the United States and other major developed economies. There will be a lot of wealth both destroyed and transferred. This is always the case in bear markets. The challenge is not to be fearful, but to be knowledgeable about how events are likely to unfold. No one has a crystal ball, but sometimes the only thing that is needed is common sense. We suggest you give a lot of thought to what is likely soon to emerge. One area we see as a possibility is a coming commodity supercycle. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or there's no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis and coordination. I'd like to take a moment as a reminder. Do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.